2008 housing market crash repeating itself? Protect yourself from the worst housing crisis yet. If you're thinking of buying a home and wondering if another crash is coming, then this video is for you. During times of economic instability, making a significant financial choice, such as purchasing a home, may be an extremely stressful and uneventful experience. Even in times of overall economic optimism and high hopes, the situation may seem like the worst is about to come, and you don't want your beloved home to be a collateral damage in the process. One of the factors that determine the winners and losers in the real estate and investment industry is one's mindset and how well one thinks and plans ahead. The number of people searching online for information on what brings down the value of the home market continues to surge. So basically, just like you, there are millions of people who are seeking help and information on what to do in the event that the housing market collapses, and if ever there is a demand for housing in 2023. Some experts say that there is a good chance that the housing market won't experience a crash in 2022. But if you've seen the channel's previous videos on investing and having an investing mindset, then you would know that a savvy investor knows how to research and plan ahead of time. If you haven't seen these videos yet, feel free to check out the channel. Oh, I'm sorry, I forgot to introduce the channel. Hi, welcome back everybody. Or if this is your first time here, welcome to Finance Bureau, your go-to handbook where we talk about anything related to cryptocurrency and finance. I'm glad you can make it. So, going back to the video, it is better to be knowledgeable and become aware of the signs that follow a crash. When do you expect the next crash in the housing market, home prices, and the labor market? Will the prices of homes and the interest rates on house loans fall in 2023? In 2023, do you predict a decline in mortgage interest rates, mortgage payments, or mortgage defaults? Remember, we did not anticipate what 2020 has brought to the world. 2020 made it extremely clear to us that it is often difficult to predict the ebbs, flows, and increases in prices associated with the real estate bubble. Let's get right into it, shall we? But first of all, what is a housing bubble? According to Investopedia.com, a surge in consumer demand and a limited supply of a good or service often comes first in the emergence of a housing bubble, just as they do in the event of any other kind of price inflation. As more consumers enter the market, there is an increase in overall demand. Then the speculators come in and start buying up investment homes and fixing and flipping houses that need work. Because there is a limited supply and there is so much fresh demand, prices are going to have to go up. At some point, the cost of goods and services may reach an unsustainable degree. The typical buyer, or even the buyer who is above average for the area, will find that the prices of homes have become too expensive to afford. A bubble is a fleeting turn of events. In the stock market, they occur instantly and have the potential to burst even more rapidly. According to research conducted by the International Monetary Fund, a housing bubble may last for a number of years. However, external influences have the potential to deflate a bubbly property market at any point. When interest rates on mortgages go up, the monthly carrying costs become unaffordable for a greater population of Americans. A deteriorating economic situation results in a rise in unemployment, which removes more potential customers from the market. When investors' nerves are ruffled, they stop searching for properties to work on or flip. So, we need to address the elephant in the room. Is the US housing market going to crash? You might be wondering to yourself, will the housing catastrophe that occurred in 2008 happen again? Are we on the verge of another emergency situation? And just how severe will the impact be? For the last 2 years, we have wondered when the next big crash will be. The fact that it has already started to happen was demonstrated in the previous 6 months. Increasing interest rates by only 1 or 2 percentage points is more than enough to bring down the stock market that has been booming. During the pandemic, several businesses saw a doubling in the price of their shares of stock. However, after the pandemic, those gains were lost, and the companies are now back where they were before the COVID phase. Those that were able to sell their shares before the stock market crash must have made substantial gains. However, since most stocks are owned by the wealthiest 10% of Americans, a stock market meltdown is of little concern to most individuals. However, you should start to get worried when the real estate prices crash, because you and I, and everyone else, are negative negatively impacted if there is a drop in the price of real estate. Since everyone needs a home to live in, the cost of housing increased by more than 10% in 2020 and over 20% the following year. These kinds of price hikes hadn't been witnessed since 2005 or 2006, just around the time when the housing market was about to enter a collapse that would drag the whole economy down with it. And since the Fed is increasing interest rates, the housing market is becoming more unsustainable. At this point in time, the residential real estate market in the United States is not in any danger of crashing. However, it does not prevent interested investors, house buyers and sellers such as you and me, from going online to check on the state of the housing market in the United States. Simply by making the phrase housing collapse a common household word on the internet in these modern times, internet users may be adding fuel to the fire that may eventually lead to a crash in the housing market. According to a new study by the luxury brokerage company Ruby Home, the spike in searches about a housing crash suggests homeowners, particularly those thinking of selling, are increasingly nervous about their market timing. The Ruby Home report stated, if interest rates keep going up, purchasing power will continue to erode, putting more downward pressure on home prices until they reach parity with what people can afford. Some of you here might be afraid of another 2008 financial crisis, and I totally get where you come from. The housing bubble that resulted in the financial crisis of 2008 was caused by a variety of factors, including the availability of cheap loans, unethical lending practices, and financial engineering, which resulted in a large number of borrowers being trapped in unsustainable mortgages. When things finally got out of hand, it sparked a crisis of house foreclosures among homeowners, a credit crisis among investors who bought bonds supported by failed mortgages, and it brought in a severe recession. All of these problems were caused by the situation reaching a boiling point. As a result of the economic crisis, the total wealth of millions of households in the United States fell. According to the Bureau of Labor Statistics, between the end of 2007 and the middle of 2009, approximately 9 million jobs were lost in the United States. The median income of a household in the United States fell from $54,489 in 2007 to $52,195 in 2009. This is a decline of 3%. That's pretty scary, isn't it? But what do the experts say? Economists are in consensus that the housing market in the United States is now experiencing a slowdown rather than the crash that is impending. It is essential to make a distinction between a slowdown and a complete collapse of the market. In other words, this is not a financial disaster of the same scale as the one that occurred in 2008. By the year 2022, almost all of the American families had returned their nominal combined wealth to their normal levels or the levels it had reached before the crisis. In spite of the fact that the pandemic knocked the economy for a loop, the labor market has regained 93% of its lost jobs, and the unemployment level has now dropped to only 3.6%. So it is in the opinion that the housing market is in a far better situation than it was in 2008. This is due to the fact that lending criteria have become more rigorous and property prices have risen to record highs. But what do you do in case of a housing market crash? How does one prepare for the absolute worst? Here are some general tips to get you started. Fair warning though, just so you know, Finance Bureau is not a financial advisory channel. Never consider anything you see here as professional investment advice. No information provided verbally, in writing, visually, or otherwise is intended as a recommendation to purchase, sell, or hold any asset. All of these convey opinions that may or may not be true. Before putting your money into anything, please conduct your own comprehensive research. Moving on to the video, prioritize staying within your financial means. It's important to recognize your financial limits and never exceed them, no matter how tempting several investments could seem. You may do this by consulting a bank or other source of financing. It's important to invest just what you can comfortably afford in real estate. Your home might lose value if the housing market suddenly crashes. When you consider the additional financial hardship a crash might bring, it's clear that you won't be able to keep up with your loan payments and will be forced to sell your home. Your home or investment property will be worth the least during the crisis. The present real estate market bubble makes this very possible, but it is nevertheless important to prepare for it just in case. Take your time. there is no need to panic and hurry into purchasing or selling a home. Every investment choice you make as an investor should be the product of thoughtful consideration and research. Before making any investments in real estate, you should do an in-depth study of the market. It's easy to be entangled in the rush of purchasing at a high price during times of crisis if you're worried that the price will only go up from here. However, like with any investment, you need to think outside the box if you want to see a substantial gain. I have a video about this. Feel free to check it out. The moment to invest is not when there is a mad rush to purchase, since you will end up paying more than your home is worth. Set aside funds in the event of unforeseen costs. Property investments need a long-term commitment, sometimes spanning 10, 20, or even 25 years. In case you ever find yourself unable to meet your regular payment commitments, having a savings cushion will come in handy. You may protect yourself against this risk by purchasing renter's insurance or vacancy insurance. You can ride out a real estate market fall for a few months in relative safety if you have some cash stashed away, and you can reap the benefits of other investing possibilities. What are some of your investment tips and recommendations? I want to hear your thoughts. Just leave a comment below, and always remember to be respectful in your discussion with others. The next tip is to put your money into properties with a good return. Before making a real investment in the property, it is crucial to determine whether or not it will be profitable. A property that is able to generate income will retain more of its value throughout the recession in the real estate market. In addition, if you have a rental property, your renters will still be obligated to pay their rent even during a recession, since housing is a necessity in any scenario. There is little danger of a real estate crash affecting you and your ability to sell your house. That's why it's crucial that you give serious consideration to your investment idea. As much as possible, seek help and make use of a specialized professional on these matters. Final tip: spread your money around. Diversify your sources of income. The final approach is necessary since it may reduce the likelihood of monetary loss. If you have all of your financial eggs in the real estate basket, a fall in the market might wipe out all of your fortune. Therefore, if you want your money to be as safe as possible, diversification is important. This might be putting money into the stock market, a particular cryptocurrency, gold, or a real-world or online enterprise. One should never put all of their figurative eggs in one basket. If you want to learn how to diversify your assets properly, it is a good idea to find an expert who can assist you. As an end note, investors in the stock market are willing to accept the possibility that prices may fall from time to time, and occasionally the dips will be significant. On the other hand, homeowners may believe that the value of their property would never decline by all that much. They are not entirely incorrect. The housing market, historically speaking, has not been subject to the regular price bubbles and high volatility that are found in other investments. However, real estate markets are prone to times of irrational exuberance, which are often preceded by times of declining demand and falling prices. Investing in stocks or bonds is far less risky of a choice than making the decision to purchase or sell a house. However, some of the same investing ideas still hold true, such as focusing on long-term averages rather than the fluctuations that occur over short periods of time. This is it for the video. If you learned something valuable with me, don't forget to hit that thumbs up button and subscribe for more financial content. Share your thoughts by leaving a comment below right now. Thank you for watching. See you on the next one.